In this video, we're going to discuss on the issues of accounting of equity-based financing. We're going to separate our videos into 5 sections. On the first section is the scenario and basic information on Islamic finance. On the second section, we're going to look upon differences between Islamic accounting and conventional accounting. On the third section is accounting of equity-based contract. On the fourth section is the nature of financial instrument. Is it debt or equity? And lastly is a conclusion on the issues. Mahmoud is a successful businessman. He wants to expand his business. As a Muslim, he feels uneasy about borrowing from conventional bank because the loan need to be paid with interest, and this is prohibited in Islam. Unlike conventional finance, Islamic finance operates without interest or riba, which is prohibited in Islam. Instead, Islamic finance activities are based on trade. They don't use risky speculative practice, but generate return from low-risk physical assets such as property and metal. Using principle of partnership and reward sharing, the relationships are based on trust, openness, and respect. Islamic accounting identifies socio-economic events and transactions measured in both financial and non-financial terms, and information is used to ensure Islamic organization of all types adhere to Sharia and achieve the socio-economic objective promoted by Islam. Let's hear Dr. Shamim Siddiqi's view on Islamic accounting.
For accountants who have been brought up with the knowledge that accounting is a technical, value-free and objective discipline, it may not be easy to accept the term Islamic accounting. However, in an Islamic economy, like any other system, business community has a role of stewardship towards society. Islamic laws define duties and guidelines towards employees, customers, and competitors. That is why objectives of Islamic accounting include ethical aspects in a more significant way compared to the conventional system.
In accounting, there are 4 accounting assumptions. First, substance over form. Second, time value of money. Thirdly, fair value measurement. And lastly is recognition based on probability. There are 4 categorizations of Islamic finance contract. First, sale-based contract. Second, equity-based contract. Third, debt-based contract. And lastly, charitable contract. In this video, we're going to focus on equity-based contract. The equity-based contract category includes the Islamic finance principle of partnership musyarakah, profit sharing, mudarabah, investment agency wakalah, followed by much less common principles such as muarasah, musaqah, and muzara'ah. Looking back to Mr. Mahmoud's scenario, now Mr. Mahmoud may apply equity-based financing such as Musyarakah Mutanaqisah, which is in accordance with Sharia. Musyarakah Mutanaqisah or diminishing partnership is a contractual arrangement with key 4 components: a musyarakah contract, an ijarah contract, a service agency contract, and a legal charge contract. In some cases, a promise to purchase and a sales contract are also included. In accounting, equity-based instruments such as Musyarakah Mutanaqisah are reported as if they were financing arrangement under International Financial Reporting Standard (IFRS), while IFRS accounting treatment look into substance over form principles. They should follow Sharia requirement nature of musyarakah. The theoretical perspective of Musyarakah Mutanaqisah financing is that there will be a periodical transfer of the asset at its fair value, and this may result in variation from the actual projection of liabilities. However, the current practice is that Islamic banks list their ownership right of Musyarakah Mutanaqisah financing under an ijarah contract. Thus, the theoretical perspective of Musyarakah Mutanaqisah financing is no longer applicable. The gradual transfer of the Musyarakah Mutanaqisah assets ownership over the tenure of the contract just does not happen. The beneficial ownership of the asset is transferred at the beginning of the contract, and the Islamic bank only claims right to the assets in the event that the customer fails to make the minimum lease payment. Therefore, the periodical payment of the account would only result in reduction of customers' outstanding value of the Musyarakah Mutanaqisah financing. There are no accounting record for the gradual transfer of ownership. As conclusion, due to the Musyarakah Mutanaqisah contract followed by Ijarah contract in Musyarakah Mutanaqisah Financing, the accounting treatment of Musyarakah Mutanaqisah Financing is not consistent with those recommended by Sharia scholars in the literature. The Islamic Bank did not report their share in Musyarakah Mutanaqisah assets and subsequent political fair value measurement and other related issues. Islamic Bank recognized their revenue based on the effective profit rate method, and the amount invested in the Musyarakah Mutanaqisah asset is disclosed as loan and receivables or financing advance or others. It is suggested that the regulator look into the matters and provide solution. Thank you so much, and that's the end of our video for today. Don't forget to follow me, Takir Hamzah.